Happy Thursday, everyone. We're just giving everyone another minute to join, probably 30 seconds at this point. I did just make this announcement, but it turns out we were on mute. So we'll give another 30 seconds and we'll go ahead and get started. All right, everyone, we'll get started. So to all that have joined, good morning and or afternoon, wherever you may be. Before we do jump in, we want to thank everyone for carving out time in their schedule to join us for part one of this 5-part webinar series, which we'll provide an overview of momentarily. So who are we? I am Ryan Egan, a senior manager in Riveron's Atlanta office. With me is Mehta, managing director in our Houston office, as well as Craig Rowling's lease extraordinaire and enthusiast from our DC office. Additionally, we are joined nationally by a few colleagues that are on to aid in answering any niche, industry-specific questions that may arise. As a result, we are represented with great geographic and industry dispersion. So please do not hesitate to ask any questions. Should it require any additional thought, you win the right to obtain that answer over free coffee or lunch. A couple more housekeeping issues. We are using Zoom for all parts of the webinar series. If you are just dialing on your phone, please also considering accessing the presentation via Zoom or a web browser. This aids in asking questions, answering poll questions, and seeing the presentation. If you are using a browser, we have had people experience issues if they aren't viewing the presentation in full screen, so take that into consideration. All questions can be asked by selecting the raise hand button at the bottom of your screen, and we will unmute you, as everyone will be muted during the presentation. However, the best way to submit a question is the Q&A button adjacent to the raise hand button at the bottom of the screen. You can elect however you want to ask said question. As a draw today is gaining expertise on the new leasing standard while getting CPE, please know that answering 4 of the 5 polling questions and being present for 50 of the 60-minute presentation will make you eligible for 1 CPE credit. As mentioned, this is part 1 of a 5-part series. Here you will see the dates, times, and topics for each part. Each webinar will be recorded, as is this one currently. So should you find yourself in Aruba on a baby moon May 9th, do not fret. You will be able to access the webinar content. However, just know that since you are not accessing the webinar live, you are not eligible for CPE. So now that we have all of that covered, let's jump in. As each attendee knows, is learning or soon learn, adopting the new lease standard can be a massive undertaking. Fortunately, there are practical expedients available to mitigate some of the burden. With that said, Addie, what are some key practical expedients our attendees should be aware of and considering?
Yeah, thanks, Ryan. A great introduction, by the way. Good morning to you all and good afternoon for those on the East Coast. So let me start off by saying that there are really 2 types of practical expedients that are available under the standard. There are those that are available only at transition, and then there are those that are available to ease the ongoing accounting for leases. The first 2 expedients that we'll talk about today are expedients that are available at transition. So the first one is the package of practical expedients, and this allows for entities not to reassess whether expired or existing contracts contain leases under the new definition of a lease. 2, lease classification for expired or existing leases. And 3, whether previously capitalized initial direct costs qualify for capitalization under 842. Key points to note here is that all 3 of these items must be elected on an all or nothing basis, and they have to be applied consistently to all your lease contracts. And election of all these practical expedients does not allow for grandfathering of errors in applying current guidance. And what that means is if you fail to appropriately classify your lease under 840, or you fail to identify a lease under 840, just by using this expedient, you're not going to be able to grandfather those errors when you implement and adopt ASA 842. Another point to note is that most entities are electing this particular practical expedient because this definitely reduces the level of effort and time it takes in adopting the standard. The next practical expedient that we will talk about is the use of hindsight practical expedient. And what this does is it allows for entities to use hindsight in determining the lease term and in assessing the likelihood that the lessee purchase option will be exercised. Also, it allows an entity to use hindsight in assessing the impairment of ROU assets. The hindsight practical expedient applies to estimates and judgments in the application of lease accounting, but does not apply to changes in facts such as those resulting from changes to the terms and conditions of a lease, for which one would apply lease modification accounting. This particular election must be applied consistently to all leases. And while this practical expedient results in the most accurate lease liability and ROU asset on the effective date, on account of using the most up-to-date or current expectation in the determination of the lease liability and ROU asset, most companies with large lease portfolios are not electing hindsight because since this can be a significant undertaking and delays the finalization of the day one impact of adopting ASC 842.
Wow, Adi, that's great. So before we jump into more expedients available, let's jump into our first polling question. What progress has your company made in adopting the new standard? Are you in the assessment phase still? Have you started extracting lease data? Are you implementing a lease accounting system? Or have you not started? So we'll give everyone about a minute to get their answer in. Again, please try and answer 4 of the 5 questions to be eligible for 1 CPE credit. So we're going to end polling now, so get your last second answers in. So the results are up. It looks like 42% of us have not started or are in the preliminary stages of adopting 842. If you're a private company, that certainly makes sense, given you still have some runway. But as mentioned, it is a significant undertaking, so you do want to start planning for it. And if you have any questions that arise during the planning process or any other stage you're in, we're always available for insight. So Adi, I found the expedient issued by FASB last January to be very interesting. Can you shed some light on the land easement expedient for our guests?
Sure. So let's just talk about what a land easement is first. So a land easement, also commonly referred to as a right-of-way, refers to the right of use, access across another entity's land for a specified purpose. This was a fairly hot topic in early 2018 as public companies began assessing the impacts of adopting the standard. What they quickly realized was that accounting for all easements was going to be fairly onerous, since some entities had easements in excess of in the tens and thousands, right? In response to the stakeholder concerns and requests, the FASB issued this expedient to reduce the burden of adopting the standard. The expedient allows an entity to elect not to assess whether existing or expired land easements that were previously accounted for, that were not previously accounted for leases, under 840 contain a lease under 842. This expedient must be applied consistently to all of the existing and expired land easements that were not previously accounted for as leases under 842. In other words, the expedient doesn't apply to land easements which are currently accounted for as leases under 840, or land easements that the entity will enter into on or after the adoption of ASC 842. The one more point that I'd like to make is there's currently a lot of disparity in the accounting for right-of-ways and land easements by entities. Some entities account for these as leases, some others as intangible assets, and some as PP&E. And a lot of, there's just this disparity is what the FASB is trying to avoid going forward by clearly defining a land easement as being as meeting the definition of a lease. And so going forward, we would expect to see accounting for land easements that is fairly consistent across industries.
Very interesting, Adi. So that leads us to our second polling question, which is, what is the impact of FASB's land easement practical expedient to your company? And again, we'll give everyone about a minute to answer the question. So we're going to end polling. As expected, the impact from the expedients either minimal or attendees are not sure. That's in line with what we expected, but it's still a very interesting expedient to consider. So with that in mind, let's now talk about lease and non-lease components and the expedients available to both lessees and lessors.
Yeah, Ryan. So there are two expedients available under 842 that deal with lease and non-lease components, one for lessees and the other one for lessors. Some background on this. So under 842, a lessee needs to separately account for the lease and non-lease components in an arrangement. So you think about, I'll give you a couple of examples here. You think about, your typical cable TV contract with let's say Comcast. The service component in that specific contract is a subscription to receive content, TV viewing content, whereas the lease component is the cable box, right? So you've got two different components within that arrangement. Think about another situation, which is your transportation arrangement, where the shipper uses a specific asset like a truck or a ship or a plane to transport product for a customer on an exclusive basis. So transportation service itself needs to be separated from the lease of the asset used to provide the service, and therefore you have two different components. Another example might be real estate, where you've got real estate leases where you're paying for the lease of your office space, but then you also have payments for taxes and insurance connected to that the lessor needs to be paying, as well as some common area maintenance charges that you pay regularly for in your real estate leases. So these are just different examples of situations where you have different types of payments you're making on a lease, and therefore different things either for a service or for things like CAM. The concept of separately accounting for lease and non-lease elements exists in current guidance under 840, but this, and most companies have not really gone in and done an evaluation of what whether to separate and what the impacts of that separation is going to be. And this has not been a big deal so far, just because didn't result in any sort of financial impacts because operating leases were not required to be recognized on the balance sheet. And the entire cost of both the lease and the non-lease element was being booked to an expense on your income statement. With the new standard and the requirement to capitalize operating leases on the balance sheet, the separation of components now is more meaningful and can lead to differences in the cash flows used to determine the lease and non-lease components, and therefore the determination of what your lease liability and ROU asset is going to be. So that's why this is of importance today, and this is something that most lessees are struggling with, because it definitely creates a lot of complications and greatly impacts the amount of time they're going to need to account for their existing lease contracts that have other components. So the expedient that's been made available allows for lessees to elect not to separate the non-lease component of a contract from the lease component to which they relate, and treat the components as a single lease component. This election needs to be made by class of underlying asset. Now, when the FASB issued this particular expedient, the FASB's understanding was that most lessees that have a material non-lease component would be dissuaded from electing this particular expedient, just because that would result in a higher lease liability and a corresponding lease asset on their balance sheet, and it would just be, they would elect this expedient for class of assets where the non-lease component was either immaterial or was a very small part of the overall arrangement. The biggest pro of electing this expedient is that it greatly reduces the amount of time you're going to spend in accounting for these leases, that especially with service arrangements and embedded leases that have non-lease elements. I'll move on to the second expedient that relates to lessors. And the second expedient was issued in response to feedback from numerous stakeholders by the FASB when they issued this in late 2018. Lessors, particularly those in the real estate and the drilling industry, requested relief from having to separately account for lease and non-lease components. And there were really two reasons that they provided to the FASB. The first was they were unable to support the standalone selling price for each component, because they typically offered their service offering involved both the service as well as the asset, never offered either the asset or the service separately. And so they didn't have a good basis to support the standalone selling price for each one of those components. The second reason that they provided was identifying revenue as lease revenue or non-lease revenue would not be in alignment with their stakeholders' expectations. For example, a drilling company stakeholders identified the drilling company's business as being a service as opposed to a leasing business. So given these facts and circumstances, the FASB went ahead and issued an expedient that allows lessors to elect not to separate the non-lease component of a contract from the lease component to which they relate, and instead to account for both those components as a single lease component, except that there were two additional requirements that need to be met. One, the timing and pattern of transfer for the non-lease component, the related lease components were the same. And what this really means is that the services were being provided simultaneously or at the same time as the asset was being utilized by the customer. And two, the lease component would be classified as an operating lease. So they just want to make sure that by combining and accounting for these as a single lease component, you weren't tripping up the classification of the lease. Furthermore, as a lessor, entities will also need to evaluate if the lease and non-lease component is the predominant component of the contract to determine which standard they were going to apply to that arrangement. So, for example, in my drilling contract example that I provided, if the drilling company assesses the service as being the predominant component, then they would account for the entire arrangement as under pursuant to 606. However, if it was real estate and really the asset had so much value that was the predominant component, then they would account for the entire arrangement under 842. The one thing to note here is that the determination of the predominant component requires a fair amount of judgment, considering that there's no specific guidance on how to determine which component is a predominant component within an arrangement. And the FASB is, has purposely not provided some sort of bright line test or bright line number to say, okay, if services are 50% or 60%, because it's a facts and circumstances based evaluation, and a significant amount of judgment needs to be applied in determining which component is the predominant component.
Great, Adi, that was very insightful. So it's now time for polling question 3. Do you plan to elect the practical expedient to combine lease and non-lease components across one or more asset classes? So we'll go ahead and end polling here. And it looks like the overwhelming majority is yes, with some still undecided, but I think from what we've seen, most will fall into bucket A as well.
That's right. And what we've seen is entities are more concerned about the ease of accounting for these type of arrangements as opposed to the numbers that get on the balance sheet. And so I've, personal experiences, unless the service element is, when you think about this from a lessee perspective, unless the service element is so large that it would significantly inflate the balance sheet, most lessees are electing this particular expedient on most of their arrangement of asset classes.
Great. So before we move on, we did get a live question that we actually want to backpedal to. So Craig, if you wouldn't mind posing the question.
Yeah, absolutely. Thanks, Ryan. Adi, we just had a question regarding the lease and non-lease components. And the question that's being posed is what sort of industries, or what category of industries need to look out for these? Is there a commonality between an industry and a high number of non-lease components that they're finding? Just to maybe dig down into who should be looking out for this mostly.
So in general, what you're looking for are, you find this happen a lot in industries that have significantly outsourced their, services, right? So they have service agreements with their contractors, and the economic reason for outsourcing that is to really receive a service, but there's an embedded lease element within that service. So really the service element is the predominant component, although you don't really view that from an SE perspective, but really the services element is what they're trying to, the service is what they're trying to receive, right? And so it's in those type of industries that have outsourced a ton of their services to service providers, where you would think about, whether you want to elect this or not, because what's getting on your balance sheet will be both the service component as well as the lease component, and that can be a fairly large number if you are outsourcing a lot of your services, right? So that, I think it's the magnitude of the non-lease components within an arrangement which ultimately drives whether you want to break it out or not. To the extent an entity has appetite for a larger lease liability on their balance sheet, and they want to simplify accounting, they are going to go ahead and elect this expedient to the extent they feel that they have some sort of concern about the amount of lease liabilities that gets on their balance sheet, and they have these large non-lease components. They're going to try to isolate those asset classes and not elect this expedient under those asset classes.
So coming to mind, that's really interesting. Coming to mind for me would be oil and gas and mining would be, I think, two pervasive ones where we would see that. Okay.
Yeah. So your drilling contracts, your fracking contracts, we've seen companies argue. So there's a couple of things. Let me back up here. So there is a number of reasons why a company would want to elect this. One being the magnitude of the impact on the balance sheet. The second one being, how do we get comfortable with the standalone selling prices for each of these components? So let's talk about the oil and gas industry. What we've seen is on the drilling and the frac fleets, even if companies are looking to split up the lease and non-lease components, it's increasingly difficult for them to then be able to support the standalone selling prices that they are assigning to each one of those components and get that past the auditor. So sometimes they just resort to, hey, you know what, we'll just have it all accounted. We'll just collect the practical expedient and account for all of this as one component. Just makes it easy on the accounting, and also makes it easy for those transactions to be audited by the auditor.
Interesting. Okay. Well, that's some great insights, and thank you for the question.
Yeah, not to stay too far off topic, but you mentioned auditors, and I believe we have a question about what the auditors expect from a documentation perspective. Any insights on that, of what we've seen?
Yeah, so I think the question was with respect to the package of three, or the expedient that we first talked about, and with respect to auditors, when you say I'm going to elect the package of practical expedients, which doesn't allow me to that doesn't require me to go back and reassess all my existing leases under 842. I think what the auditors are going to want to know is, okay, what have you done, one, around the completeness of your lease populations? How did you make sure that all leases have been accounted for under topic 840? And then two, how did you make sure that, what did you do to make sure that the classification under 840 was appropriate, right? And you're going to have to prove that, you did some sort of sampling to ensure that both the classification as well as completeness was ensured, such that you could then grandfather those conclusions when you adopted 842. So that's, and again, it's going to depend on how, the amount of work that you have to put into this is going to depend on the size of your lease population, the size of your balance sheet, and how material that those lease balances are going to be to your balance sheet. So materiality and the number of leases and the complexity of your organization is going to play a large role in determining how much work you're going to have to do to prove to your auditors that your existing lease population has been accounted for appropriately.
Great, thank you for the question.
Yeah, if there are any follow-up questions, feel free to submit them via the Q&A link or raise your hand. So in an effort to get back on topic, I think there are a few other expedients available for election for companies that we haven't touched on. Adi, can you comment on those?
Yeah, so moving on to some more simpler expedients that are really going to be useful to account for leases on a go-forward basis. We'll start with the portfolio approach. So entities may be able to apply the guidance in 842 to a portfolio of leases with similar characteristics if the entity reasonably expects that the application of the leases model to the portfolio will not differ materially from the application to the individual leases in that portfolio. So all of that is just to say, if you have leases that are fairly similar, and you enter into those leases during a month, let's just say, you could apply a portfolio approach and account for the estimates that go into lease accounting. For example, your discount rate. You could use a discount rate for that month to all of the leases that were like type that were entered into during that month, as opposed to accounting for each lease individually. Right. So that's something that we've seen companies do and elect, especially if they're getting into lease. Their business requires them to enter into a significant number of leases on an ongoing basis that are fairly similar to one another. So similar terms, similar type of assets, that sort of thing. The next one is short-term leases. So entities as a lessee may elect not to apply the recognition measure requirements of AS 842 to short-term leases that has been defined as leases of 12 months or less, and instead to recognize the lease payments as lease costs on a straight line basis or the lease term consistent with legacy US GAAP. So what this is really the short-term lease exemption, and this is an expedient or exemption that's available and most talked about. It was a pretty hot topic when it first came out. Most people said, hey, I've got leases and none of them are more than a year. So this lease accounting standard doesn't really affect me. And, there's been a lot of back and forth in thinking on short-term leases. But the one thing I want to highlight here is there's a significant amount of judgment involved in determining what the lease term is on leases that have evergreen provisions, right? So I've had a number of clients that have month-to-month leases, or they have a lease for 6 months and then it goes evergreen from that point on. And, either party can terminate the lease with 30 days notice and things like that. Or you've got, a lease which is, a year long, but then you have automatic renewals, or you've got renewal provisions that can be exercised by the lessee. And in such situations, it's important to make a determination of what your policy is going to be around the lease term, right? So making a determination of what, at lease inception, how are you going to consider what the lease term is, and how are you going to consider whether it's, you're going to exercise some of those renewal options or not, right? So the threshold under the old guidance and the new guidance is the same, the reasonably assured or reasonably certain threshold that you have, and it's important to make a determination on whether you meet that threshold to consider those additional renewal periods in the determination of your lease term, because that's going to drive whether you meet the short-term exemption or you don't, and that's going to drive whether you have to bring those leases onto your balance sheet or not. Finally, on this topic on short-term leases, I'd like to say that this election is made by a class of underlying assets. So if you've got, let's just say, tools, I've seen tools as being, an asset class where you see a lot of short-term leases where the tools are generally being used for a couple of months and then returned. So you apply this short-term lease exemption to the entire asset class. Now, the one thing that I found entities struggle with when they apply this expedient is there's a disclosure requirement for short-term lease cost, and therefore entities, even if you're not bringing this on your balance sheet, you're now going to have to separately track all leases that you've now identified as being short-term in order to appropriately disclose what your short-term lease expense is going to be. Finally, we'll talk about discount rate, and these are for private companies or non-PBEs. So what the standard requires is you need to use a discount rate to discount back your future cash flows associated with your operating lease in order to bring them onto the balance sheet, right? So the discount rate can either be the rate implicit in the lease, and most of the time lessees are not privy to that information, or the incremental borrowing rate. And the incremental borrowing rate is the rate that the entity would pay to hypothetically finance the lease asset. This can be a fairly onerous task to come up with this rate, and therefore the FASB provided some relief to private companies in that private companies can use the risk-free rate as their discount rate as opposed to calculating what the incremental borrowing rate is. So this is a huge relief for companies that don't have easy access to, to information, financial information that takes into consideration their credit ratings and things like that in order to appropriately determine what the incremental borrowing rate is going to be. The biggest, I'd say, disadvantage of using the risk-free rate would be that you generally would be recognizing a larger lease liability on your balance sheet because the risk-free rate is a lower rate is typically going to be a lower rate compared to your incremental borrowing rate.
Eddie, this is actually a good segue for a question that we've been given. At the moment in the market, are we seeing any differences or trends in how public and private entities are leveraging the FASB's practical expedients?
So I think, obviously most practical expedients are being elected by public companies. Obviously there's the one that is on hindsight specifically that public companies are, or really most companies that I talk to are not thinking about. I've only seen hindsight applied in situations where a company has very few leases, or a company, maybe went through a fresh start accounting or something like that, and therefore the lease liability is not going to be significantly different whether you use hindsight or not. So that's when they just elect it and have the most latest and greatest information on their balance sheet. But other than that, I mean, when you talk about land easements, if it's really something that's of impact to you, you're going to elect that, both private and public. The same goes with separating lease and non-lease components. And obviously for the public companies, they don't have the ability to choose a risk-free rate, so you're going to obviously not have that there. But most public companies are going to have to use the implemented borrowing rate, and most private companies are leaning towards the risk-free rate just because it relieves them of the burden of having to calculate that on an ongoing basis.
And that it's so true. Just mentioning the IBR rate, something that we found in multiple projects with public entities is just the onerous task of calculating the IBR rate. It's something that tends to be an afterthought, but is obviously extremely important and does take quite a while to calculate accurately. So that is an observation that we have. Well, thank you very much, Eddie.
Great. Well, at this time, I think it's time for our fourth polling question, which is, how many leases do you have in your portfolio? So the polling results are up. It looks like a healthy mix of folks on the call. We'll say 50% of attendees have a lease portfolio of 100 plus leases. I think your lease portfolio is an interesting topic of discussion. In looking at the answers and the lease count range, Addie, what have you seen from a client perspective about the threshold or number of leases that you would consider significant enough to warrant the expectation that adopting 842 would be onerous? And to that extent, how are people handling portfolios that are more robust, not only from a type of lease, whether it's real estate or property, but just the sheer quantity?
Yeah, so in my experience, people that have less than 50 leases, I would say 50, maybe 100 if you stretch it, it's a lot easier for them to get their hands around completeness. So let me back up. I think the big ticket items are where we see entities spend a ton of time when they're adopting the standard is, one, ensuring completeness of their lease population, two, abstraction of lease key data terms, the lease terms, three, standing up a lease accounting software system, and then four, testing and running those reports, right? Those are the four key areas that we typically see companies spend a lot of the time. And of course, there's the accounting policy, elections, and all of that, which would maybe be a fifth. So thinking about, obviously the smaller the population you have, the lesser the work on all the aspects of implementation. So I think that, what I'm seeing maybe companies with 0 to 50 leases, one of the things that they can perhaps get away with is the system implementation part, right? And they perhaps can do this in Excel. I think it'll still be a lot of work on a go-forward basis. And I always remind my clients that, yes, you have 0 to 50 leases today, but what if are you expecting, or is your business changing such that you're going to have a lot more leases down the road? And the question, and sometimes entities or companies think about that sort of stuff and say, yeah, well, if today I have 0 to 50 leases because I'm applying the practical expedient on easements, and so I don't need to account for existing easements. But let's just say tomorrow, every easement arrangement that I get into going forward is going to be accounted for as a lease, and I enter into hundreds of easement arrangements on an annual basis. So that's going to quickly take my lease population up as I continue down the road. And for that reason, I may as well invest in a leasing software that's going to help me and ease out the accounting for my leases on a go-forward basis. So short way of saying 0 to 50 leases, you could possibly get away with Excel. Anything above 50 leases, you would be best served if you had some sort of lease accounting system that's doing your accounting for you.
So for those clients with 0 to 50 leases, if they do elect to use Excel, and I don't know if you've seen this from any of your clients, but what are the control implications as auditors pick this up? And obviously, that's something that's either just occurred or is occurring as we speak, but obviously a lot of the auditors have been involved in helping them review some key elections and decisions that they make, and are surely looking at some of this data before it slaps into their financials. So have you come across any control issues or nightmares that people kind of last second pivoted to a leasing software to help in those efforts?
Yeah, absolutely. So there's, the ongoing accounting guidance under 842 is quite a bit different from 840. Under 840, when you had an operating lease, you book it on day one, and then you kind of forget about it, and you just, as long as you're accounting for the expense on an ongoing, on a straight line basis, you don't have to go back and, there were no concepts of reassessments and all of that. 842's got this concept of reassessments where if you happen to have a triggering event, you need to go back and reassess the lease, and then reassess what your lease liability and lease asset's going to be on your balance sheet. And that requirement basically requires you to then monitor your entire lease population to ensure that you have the most up-to-date information that's being used in determining what your lease liability and assets is going to be. Furthermore, you've got complications such as impairments of right-of-use assets. So if you had an impairment event and you had wrote off your right-of-use asset, the accounting can get fairly complicated. And then if you're doing all of this in Excel, it just begs the question on, how often are you updating that? What controls and process do you have in place to ensure that the reporting that's coming out of the Excel workbook is complete and accurate, right? So I think those are some of the questions that companies are dealing with when they use Excel. Not to say that if you're using a leasing software that alleviates some of those concerns, but I think at least from an accounting perspective, as long as you've got controls to update your lease population for the latest and greatest events that have occurred, you can at least rely on the software to do the mechanical calculations such that you can book those leasing entries into your books and have lesser questions or less concerns from the auditors.
Great, and I believe we dive into a little more of the leasing software components and how they can help in this process in future webinars. So we'll leave that there, but certainly a great topic to think about. So last but not least, let's discuss the transition practical expedient.
Yeah, so the transition practical expedient, I'll briefly talk about what the original standard as written was requiring. So the original standard required an entity to apply the new lease accounting rules to all leases that existed at the beginning of the earliest period presented, right? So what that means is for a public company that had a 12/31 year end, they would have had to present 3 years of balance sheet. So that basically meant that they would have to go back and look at all leases that existed as of 1/1/17, and then restate the financial statements for 17 and 18 when they adopted this new standard, right? Based on feedback from stakeholders, the FASB issued an expedient in the latter half of 18 that allowed for a perspective-only application of the guidance. And what this was the FASB called this the modified retrospective transition method, and this is applied from the effective date, no different than what we've done with revenue recognition with the modified retrospective. There's no restatement of comparative periods under this approach, and this approach better aligns with the modified retrospective approach that's allowed under IFRS 16. So if you're a public company with global operations, this was definitely a blessing with respect to just transition, right? So I've seen, I'd say 100% of my clients have elected this expedient because no one wants to go back and deal with restating comparative periods. And my expectation would be that most private companies are also going to be following in the same direction.
Great. So before we go, we will get to our last polling question before we open up Q&A. How does your company intend to handle and maintain the required accounting once 842 has been adopted? Leverage a model with your current ERP, engage an independent lease accounting system, use Excel basically, or still in the decision-making process? Okay, so we'll give about 10 more seconds before closing it. See if a few people haven't answered or voted yet. That may be because they've already answered 4 and are not concerned.
Well, we hope we've been, we've been interesting enough for people to stay on the line. All right, we're going to shut the poll now.
So it looks like the majority are still determining how they'll handle it, with a good chunk of people engaging an independent lease accounting system vendor. Not a shameless plug, but we do partner with some third-party lease accounting software that is proven very beneficial for clients, and there's others that we help implement. So certainly we see a lot of value in that. We alluded to the controls issue before. So.
And Ryan, there's actually a very interesting point in that just before we continue is, being a system agnostic firm, we do see a wide range of what is available in the market, and it's really not one size fits all. There's definitely different vendors out there that match whatever lease portfolio companies have, and what it comes down to is really taking a good look at your lease portfolio before you make the decision, just to decide what the different characteristics are. And that's just going to provide some insight into the amount of cost that you need to incur to really go for one of these software vendors and to make the choice. And it is actually a very, very important choice to make too. So that's a very good point.
Yeah, that's a great point. We know we have some public company clients that are actually pivoting from the initial software they chose and implemented. So definitely a decision you want to vet very closely up front to make sure you're making the best decision. So great. So I think at this point, we'll open up the line for questions from the audience. While you are typing any questions that you may have, we will go through a few questions that we received prior to commencement of the webinar. So while you're entering, Craig, without further ado, if you want to cover those.
Great, thank you. Yep. So one thing we touched on earlier was the IBRs, Addy, and I think that there was a very good question that came through just about the application of discount rates for international items, and that is, I think, a very very poignant question. to dig deep into.
Yeah, absolutely. I think a very, really good question. We've seen some of that with global multinationals that have leases all over the world. And I think the way you have to think about that is really understanding whether your treasury function is, is that centralized or is that, dispersed across the world? Because the way, you're going to have to find the hypothetical borrowing rate for, on a fully collateralized basis for your lease asset. And if you have treasury functions all across the world, and you're probably, and your rate is not going to be dependent on the credit rating of your of the parent, then you're going to have different rates across the world. If the rate that you are, the hypothetical rate is dependent on the credit rating of the parent because your treasury function is centralized, and they're the ones that are really sourcing all of the funding for all of the capital investments or all of the operational investments that are being made across the world. Then you're going to have to, you could potentially make an argument to say, okay, well, I have one rate for all my leases of similar type and similar term across the world.
Yeah, that was a great question, because I think it's such a poignant issue with the multinationals where they do have lease holdings, in multiple locations, and so that we have seen. That was a very good question. Thank you, Eddie. Something you and I have spoken about before, and I know this is a slightly more complicated issue than I think many would give credence to, but how does adopting the 842 standard in conjunction with the 606 standard impact a company? Because one after the other has created a huge amount of burden and complexity for a lot of clients, and I think that's a question that we receive fairly often. So thank you for that. What have your observations been, Eddie?
Yeah, so some background on this. When at least my personal experience has been with drilling companies, and back in 2017, when drilling companies were looking to adopt the revenue recognition standard, they were also considering early adopting the leasing standard. And the reason being, a lot of the arrangements that the drilling companies had, had embedded leases within them. So they were on the lessor side of the transaction. They were leasing out their assets as part of their service arrangements with their customers. And so it made sense for them to think about, okay, if I'm going through the pains of revenue recognition and adopting that standard, should I also just early adopt 842? The other thing is, if you think about the revenue standard, it's really a residual standard, meaning what the revenue standard requires is for you to look at an arrangement and then carve out all of the components of that arrangement that are not, not going to be accounted for pursuant to 606, account for those components separately under whatever guidance, whether it's derivatives or leases, and then account for just the 606 components, right? So that exercise was going to be performed no matter what. And so it made sense for industries that had, arrangements where there were lease components within their arrangements to, if they were going through this whole process of bifurcation, maybe just adopt 842 along with 606 to make it, and to not have to redo that exercise a year from having adopted 606. So that was the thinking. Now, eventually where these companies ended up was they adopted 606 and then just adopted 842 per the normal adoption timeline, as opposed to accelerating or early adopting that 842. And the reason being, it was a pretty extensive exercise for adopting, each one of those standards, right? So what they felt was, okay, we've got this lessor question that we need to that we're thinking about in adopting 842 with 606. Makes is a rational. It makes sense, right? But you also had all this lessee accounting that needed to be buttoned up, and you needed to set up a software, and you needed to do all of that in conjunction with 606, which had its own challenges, right? So there were, so I think in the end, it was the burden of and the effort that was going to have to be put in to adopting both standards together that eventually resulted in companies just delaying, or not really delaying, but not adopting them together. The one thing that I can think of right now, both for the 606 and 842, that public companies suffered with was there were a lot of questions that the public companies had while in the process of adopting these standards, more technical, sometimes more just industry specific issues that needed to be worked out, that the national offices of the Big Four or the Big Six were debating. There was constant debates with the FASB, and so a lot of those questions resulted in delays in actually implementing the standard. Those things have been resolved today. So some of that effort or some of that frustration with respect to, hey, how do I really go about accounting for these type of arrangements, the private companies don't have to deal with. So there is some opportunity for private companies to, depending on their lease portfolios and the size of their lease populations, to actually consider and talk with their auditors, talk with consultants that might be helping with this effort to consider early adopting the leasing standard.
Yeah, that's a very in-depth and complex situation that you would find yourself in, and I think we can all agree, everybody on the webinar too, that FASB definitely had a sense of humor when they came up with the idea of adopting one after the other. And we have seen, Riveron operates in both spaces, consulting for firms that are adopting 606 and 842. So that was a very good question too, as we have definitely seen both. Eddie, we have 2 minutes left on the clock. I was wondering, we have one more question that I do want to quickly address, because this one we have seen a fair amount too. Just a common approach is being used for evergreen agreements with embedded leases. Yeah. Just a brief touch point on that.
So this goes back to my comment that I had about short-term leases, right? And so lease term is an area that has been of incredible amount of focus over the last couple of months, or really a year or so, as companies are trying to work through, how they come up with that estimate of the lease term. In the end, it's an estimate, and some of the considerations with evergreen leases is, is there an economic penalty for canceling the lease or not, and then when does that penalty become substantive, right? So let's think about a situation where you've got an asset on your property, and the penalty for returning that asset is going to be the cost of actually dismantling the asset and shipping it back and getting a new one, and so it's more likely than not that you're going to continue to renew the lease on that asset as opposed to terminate the lease and get a new asset, right? And so it's you're going to have to consider those facts or circumstances for each type of asset that you have, where you have these evergreen leasing provisions, and really make a determination of, okay, what makes sense economically with respect to those leases, and that will help drive the determination of the lease term.
That's great. Yeah, because I know we see a lot of those situations. So thank you again. These questions were very pointed and I think very contextual. So thank you very much. And folks, that is it for today. I'll hand over to Ryan to close out, just speaking about the remainder of the webinar series.
Yeah, so we hit 60 minutes on the head. That just shows you how good we are at timing. The next 4 webinars are up on the screen for reference. Hope you can make it. Glad you can join. Have a great rest of your day and weekend. Thanks all.
Thank you all.